Good morning, everybody. Happy Tuesday. We're going to start here in just 2 minutes or so. All right. Good morning, everybody. Good morning, everybody, and happy Tuesday. It's Serge Berger here from thesteadytrader.com. This is our Set the Market morning call, and we are going to get started right here, right now. If you're here for the first time, welcome. We're going to spend the next 10 to 15 minutes or so going through the top few things on my notepad. And if you guys have any questions along the way, please let us know. Also, please make sure that if you have not done so yet, please subscribe to the channel. That allows you to be updated in real time when we go live, and to be updated with any analysis that we do. Also, please hit that thumbs up like button. That really helps us to be able to continue to do this show. All right, top few things. I need to talk a little bit about the debt downgrade because I know there were some more questions yesterday on that, and there are actually two major reasons why it does matter. So I do want to point that out. Number two, I do want to talk about the equity rally, because there is a component here that I think is not widely talked about, but is the major reason why stocks are rallying. And no, it's not because everything's awesome. It's actually quite different, but nonetheless, stocks are going up. I'll quickly update you guys on my gold hedge, which is now gone. Again, if you subscribe to the channel, you would have been alerted to that early this morning when I made a YouTube short. So you would have received all that in real time. But anyway, let's get going. First of all, the U.S. debt downgrade, as much as it's hindsight, and I used to work with the rating agencies, so I know kind of how they work and how they think. But what I can tell you is that, we talked about this yesterday. The 30-year yield is really that we need to watch. Let me close this window here. It's loud birds. As long as the 30-year yield doesn't break and hold above the 5% mark, which we talked about yesterday, we talked about it Sunday evening as well, I think the equity market's not going to care that much. What is going to matter, though, is the following, and I think this is something that I actually didn't hear anyone talk about yesterday in financial media, which is quite interesting. So what ends up happening if you are a big and global investor, let's say you're a large sovereign fund or a pension fund of some sort, there's a portion of your portfolio where you're only allowed to invest in AAA rated securities. Up until Friday, the U.S. still had one rating agency still having the pristine AAA rating on U.S. debt, U.S. government debt, and that's now gone. So now you are going to see, at the margin, plenty of very large sovereigns and pension funds that by definition, at least in part of their portfolios, are now no longer allowed, just definitionally, to hold U.S. Treasury debt, at least not probably the long end, right? And so what that is going to do, it is going to cause more demand at the margin for commodities, particularly the hard assets, right? So stuff that when you drop it on your foot hurts, including copper, by the way, which as many of you know, we have a very bullish story on. And so one way to look at this is by looking at, for example, the DBC ETF. This thing tracks commodities in an index tracking format, and it hasn't really done a whole lot over the past, let's say, 2 years. But ultimately, we think there is a very large commodity and energy rally coming. We're not quite there yet, but the debt downgrade adds further fuel to that thesis. Okay, so that is number one. If you guys have any questions on this, in case anyone actually cares about this, then just let me know. But to me, this is critically important to understand. So it just adds more credence to our commodities, and particularly the materials bull case and the energy bull case going forward. So that's number one. It's a big point. Hopefully this is helpful. Number two, let's understand a little bit about why the stock market is going higher. I know, again, most people don't really care why. They think it's because everything is amazing. It's not actually the reason. What ended up happening is the following, and I think this is important to understand. So if you look at the budget, the U.S. budget, it's actually 3% higher in terms of deficit spending than 2024, last I checked. So what that is essentially is a stimulus, okay? That's basically called more liquidity in the market. And if there's one thing that is fuel to the fire for equities, for risk assets, including things like Bitcoin, by the way, it is more liquidity. But it's not just the U.S. that's actually now deficit spending again. And actually, my base case was coming into 25 is that we would see a bit more sort of in-check spending, and that's actually not the case. Instead of reducing spending, the spending is actually going to be more. So here is the thing. It's not just the U.S. that's actually deficit spending more. So there's no fiscal conservatism here in that sense. China, too, is actually adding a lot of stimulus. In fact, just overnight, they actually cut the lending rates again. And so if you look at China's money supplies, or basically stimulus, if you will, it just continues to go higher. This is a long-term chart for the past 25 years, and they just added even more overnight. Okay? So that is a big deal. So what's happening, if you take all this together, is that we have global liquidity increasing, and this is not necessarily anything new. Like, there are plenty of models that have forecasted this, but the tariff situation just caused a lot of volatility. But if you look at it very closely, and this is now very important, so let's go back to our S&P 500 chart. I'm looking at the SPY here, and I'm going to zoom in a bit closer so we can see all this, make this a daily chart. All that stimulus stuff started basically coming to surface more in the last sort of couple of weeks of April. And that's why the initial reaction was, okay, we've got the 90-day pause, and then we had more liquidity come in around the world in many ways, including, by the way, in Europe, where they now have an $800 billion defense budget, apparently. I don't know to what extent that's been passed or not, but that's what's going on. And then, of course, we had the 90-day pause in U.S.-China tariffs, or at least the above 100% ones have now come down to 30 and 10% respectively. Maybe that goes down even more. And that was basically last Monday's gap, so 1 week ago yesterday. And that has now pushed us well into this overhead resistance zone. So what to do here, right? It's nice for Serge to tell narratives or recap history. The point is now more, most of you, what you guys care is what to do next. Our posturing is really unchanged. We don't think that the equity market has a whole lot more upside if you look at it through a multi-year lens. So for the S&P, we're probably going to be somewhere, SPY sort of 650 to, 450 is probably the range. So 6,500 to 4,500. And even if the market here pushes over the next weeks, months, to fresh all-time highs, and it's at this point, I have to say it's not impossible. I don't think it'll be sustainable. And that's the big difference, right? So people might say, okay, well, we're back at all-time highs, and I've seen emails from people asking questions. It's everyone forgot that we were down, that the S&P was down, 15%, and their portfolios were down 10 to 15%. No one really seemed to care because we're back at flat. What no one's doing is risk management. That's another story for another time, and I'm happy to do a video on that. But what we're seeing right now is we're seeing the algos in charge, and it's because of more liquidity. And that is not something that I personally want to fight. Now, am I buying stocks up here? No. I think at this point, the odds of some sort of a pullback, even just 3, 4, 5%, seems, just too high a probability for me to buy stuff up here in any meaningful size, of course. However, I do think there is the potential that if we get even more liquidity and, deficit spending comes in even hotter than people thought, and China continues to stimulate in other places, then it is not impossible to think that we're going to see the S&P push to fresh all-time highs. I don't think it'll stay there very long. I don't know how long, so don't ask me that because we'll have to measure and map that as we go. But that is a very different story than what we've had for the past 15 years, where once we made all-time highs, we then kept going, right? I don't think that's going to be the case here. There's too many, the multiples are too high, and we're just too late in the cycle in general, and all sorts of stuff. It's a bit too much to go into it all here. I'm happy to extrapolate that a bit more going forward. But that's kind of where we are. So I do not want to rule out. I'm just gonna update because one thing that makes good traders and investors is be able to adapt, right? And having to adapt here as a near term means that we cannot rule out all-time highs. Again, even if we do make all-time highs, I just don't think it's going to last very long. But I don't want to take that off the table because the algorithms are chasing the retail investor is gambling like never before. We can see it with the flows. We see what all the brokers are reporting. We see by emails that are coming in from clients the kind of questions that are asking. It's as if nothing ever happened. And as I always say, it's going to end up badly. There's no doubt about it. A lot of people are going to lose all their money. But again, it's not like this has to end today, right? So that's kind of where we are. So that's number one, or that's number two. The next thing that I want to quickly bring up is the VIX, and then I'll talk about gold quickly. So we talk about this here over the past few weeks, of course, and the VIX is now in this area between 15 and 25, which I consider to be a more difficult place to make bets, particularly after such a big rally. So I would like to see the VIX either get back above 20 to make bearish bets, or quite frankly, dip below, at least below, 17, 16, preferably even towards 15, for me to have more linear possibilities on the upside. So that's kind of what the VIX is telling me. And then last but not least, just quickly an update on gold. I did make a new YouTube short this morning. I promised I would keep you guys updated. So go make sure you check out on our YouTube channel. That's why you have to subscribe to it. It's free, obviously. Go check out the video I just made there, give you a bit more update. But basically, I think that the gold consolidation phase here, from a timing perspective for the time being, was enough in terms of time and space, meaning to the downside, for me to at this point take off my hedge. So I'm back to unhedged gold. I'm just long. I have been long gold since the summer and then autumn 2023. So that's what's going on. What's going on there? I will say though, for those of you guys that use the trender indicator, we received an amazing momentum buy signal back in January, and then of course gold exploded. We're now getting a momentum sell signal. So if that has further confirmation, I might actually go back and re-hedge my long gold positions. I typically hedge with futures. I know some people like to use options and stuff. I just find it easier with futures. This kind of a position, but that's where we are. Fabian's asking in Japan. Well, what's happening in Japan? You probably read a headline. So what's happening in Japan is you're talking about the 30-year bond yield, right? So they had a bit of a crappy auction, and then one of the officials basically said that they're in trouble. So, this is going to be troublesome. I mean, I think this is a bit of foreshadowing for what might happen to the U.S. Treasury curve, because again, there's once again no fiscal responsibility. There's, again, as I said before, the budget for 25 is more spending, more than last year. So, if you want to draw a parallel here to what might happen to the 30-year Treasury yield, I think that is quite likely to happen at some point. I just don't know the time frame of that, but that's what's happening here. You can see the 30-year bond yield in Japan is up a lot this morning. About what is that? Yeah, like 16 basis points. So that's a huge move. If you look at the equity market in Japan, it actually didn't really care all that much. For whatever reason, it's not that important here. And of course, most important to me right now is what's happening in the currency market, and the currency market just shrugging this off too. So I don't really have a view on this right now, to be honest with you, but we'll continue monitoring. So all of you guys that are Inner Circle and Market Rover members, we'll see you over there in the member session in about 4 minutes. And then we'll be over in Trade Ops a bit later on. For those of you guys that trade and invest with ETFs, make sure you join us this morning in about an hour and 45 minutes in a special session where we are going to show you guys which ETFs are doing well. We live in we're in a sector and group rotation environment, and how you can track those and find the ones that are moving. It's just a much easier way to make money in the markets, to kind of look for the right themes, sectors, groups, as opposed to having to pick out the individual stocks. So anyway, we'll talk about that. Have a great day. Again, we'll see you guys over in the Inner Circle Market Rover session, member session, in about 3 minutes, and then over in Trade Ops a bit later on as well. Please hit the subscribe button, very important, so we can continue doing the show. Thumbs up, like, and we'll see you soon. And we'll be back here tomorrow morning at 9 Eastern.